All right, let's dive into the latest from DraftKings. They just dropped a Q2 earnings report that honestly looks like a home run on paper. Record numbers across the board. So, why did the stock basically yawn in response? Let's break down what's really going on behind the numbers. Okay, first things first, the bottom line was just a massive, massive beat. We're talking GAAP earnings per share of 30 cents. Now, the Wall Street consensus was 15 cents. So yeah, they literally doubled what analysts were expecting. That's a huge signal that their profitability engine is really starting to fire. And it wasn't just the bottom line. The top line was incredible too. Revenue hit a record $1.51 billion, which is a 37% jump year over year. But the really stunning number is the adjusted EBITDA. That's a key measure of core profit, which came in at $301 million. They didn't just break their old record, they doubled it. That's some serious operating leverage. But here is the real head-scratcher. After putting up this monster quarter, the stock did nothing. It actually closed down just a tiny bit the next day. So what gives? Why would the market just shrug off a quarter this good? That's the big question we need to answer. So let's start by decoding this earnings beat and get past those initial headlines. The real secret sauce here, it all comes down to monetization. The average revenue they get from each monthly paying user, or ARPMU as the industry calls it, shot up 29% to $151. Bottom line, they are making way more money from each customer, and that is a sign of a really healthy, maturing business. And a huge part of that was a higher sportsbook hold, which is just the slice of all bets that the house gets to keep. But the important thing isn't just that the hold was higher, it's why. Management said it was a structural increase, driven by more people making higher margin parlay bets. That's a much stickier, more sustainable way to grow profits than just getting lucky on a few game outcomes. And when you look at the whole scorecard, it was just a clean sweep. They beat expectations everywhere. Even the number of monthly users grew by 6%, which is pretty solid against a tough comparison from last year. Just a fantastic quarter, top to bottom. Now, a quarter like this doesn't just happen by accident. It's really the result of a massive strategic pivot they've been making, a shift from growth at all costs to real profitability. You can hear it right from the CEO, Jason Robbins. The focus has clearly shifted. It's not just about revenue anymore. It's about setting records for net income and EBITDA. The bottom line is officially king. And you can really see that shift in thinking right here. The old playbook, for years, was a land grab at any cost. Just get users, get into new states, worry about profits later. The new playbook, it's all about building a business that generates durable, sustainable cash flow. This is what a maturing company looks like. And hey, you want proof? Look no further. They've bought back 6.5 million of their own shares just this year. Let me tell you, a company that's just burning cash for growth does not do that. A company that's generating strong, free cash flow, they do that. This is a fundamental change to their story. Okay, so if everything is so great, what's holding the stock back? Well, that brings us to the other side of the coin, the headwinds and the catalysts. This is the million-dollar question that's hanging over investors right now. The company is executing beautifully, but the regulatory world is getting a lot trickier, especially when you start talking about taxes. And the biggest boogeyman in the room is Illinois. They just introduced this new, kind of unprecedented per-wager tax. This isn't a tax on revenue, it's a tax on every single bet, which is a huge problem for the business model, especially for all those small-dollar bets. It's created a ton of uncertainty. So what's DraftKings doing about it? Their response is pretty bold. They're just going to pass the cost directly to the customer with a 50-cent surcharge on bets. This is a really high-stakes gamble. Can they protect their profit margins without driving away users? Honestly, the whole industry is watching to see how this Illinois experiment plays out. But listen, it's not all headwinds. Looking ahead, there are some pretty exciting catalysts. A launch in Missouri is timed perfectly for the NFL season. They're using AI aggressively to cut costs, and management even dropped a hint about potentially getting into the new world of prediction markets. These are some powerful levers for future growth. So let's put it all together. When we weigh the fantastic execution against these very real regulatory storm clouds, what's our final call? Well, the case for being bullish is pretty compelling, right? The company is proving it can make serious money from its user base. It's got clear growth coming from new markets like Missouri, new products on the horizon, and AI is making the whole operation leaner and meaner. But the risks are definitely real, and we can't ignore them. The biggest by far is that state-by-state regulatory mess. The tax situation is going to be a battle for years. And internally, that user growth is slowing down a bit, which raises questions, especially with competition still being so fierce. So our final call here is outperform. We think the company's best-in-class execution, their rapidly improving profitability, and those clear growth catalysts, we think that more than outweighs the near-term anxiety around taxes. That strategic pivot to generating real cash is the real deal, and we don't think the current stock price fully reflects that yet. And that's our breakdown of the quarter. As always, just a friendly reminder that this is for informational purposes only and is not financial advice.